right now. We are recording this. Retirement planning in the age of coronavirus. So here is what we're going to talk about today. We're going to talk about where we are now, markets, economy. We're going to talk about where we're going, what might happen in the future. We're going to try to look in the crystal ball. And what can we do about it? What kind of actions make sense at this point? And then we will have time for Q&A. I expect the whole thing is going to take about an hour. And if the Q&A goes longer, Mike and I can both extend things a little bit. So first of all, for those of you who don't know me, my name is David Haas. I'm a certified financial planner, and I'm president and owner of Cereus Financial Advisors. We help clients meet their personal financial goals. We like to say we help clients make better financial decisions, and we do it through comprehensive financial planning, investment management, and risk management, which is a code word for insurance. This is my second career. I had a long career in engineering, first electrical and then software engineering. Then I passed the CFP exam in 2012, and I started this business in 2015. I do have an MBA in finance, which I actually attained in 1987, although I stayed in engineering for quite a while. And I live in Mahwah, and my business is in Franklin Lakes. And I volunteer with several local organizations, including the New York, New Jersey Trail Conference and the Financial Planning Association of New Jersey, where I am very active on the education committee. And now Mike is going to introduce himself.
Good afternoon, everyone. This is Mike Dunn. Thank you for joining us today. Like David, this is a second career for me also. So I started out after getting an undergraduate degree in accounting, working in accounting and then in finance for most of my career in an institutional capacity, working for large banks and then a large hedge fund. So I, during that time, also got an MBA at night at NYU, finished that in 1991. And I like to think that all along, even though I've been involved in institutional finance, I've taken a big interest in doing my own financial planning for our family over the years. And I'm happy to now share the benefits of my experience and knowledge with clients.
Okay. So I have to provide a disclaimer. So we're providing a lot of information in this presentation. We believe it to be accurate. We believe that it came from accurate sources. There is also a lot of opinion here, particularly the crystal ball stuff, where it's either my opinion or Mike's opinion about what might happen. And there's a high likelihood we'll be wrong. So we're just giving you an educated opinion. Any kind of investment involves varying degrees of risk, so you should be very careful about that. You should be talking to your trusted advisors, your tax advisors, your investment advisor, certified financial planner if you have one. And let's see, you can also find out more information about us on our website, including our disclosures, and you can look us up on the SEC website. That says advisorinfo.sec.gov, which I believe works, but there's also a broker check website. If you just Google broker check, you can look up anybody in the investment management area who's registered with FINRA. Okay, so where are we now? This slide is as of Thursday of last week, and it's showing the S&P 500 total return index from the beginning of the year. And as you can see, it reached a high on February 19th, and right around that time is when we really figured out, hey, this COVID-19 thing, is going to be affecting us. And the market suddenly panicked, and of course markets love to panic, and there was a big sell-off, and although it wasn't straight down, it was pretty straight down, and it reached a low on March 23rd. And that low was right around 30% since the beginning of the year. Since it had gone up 5%, it was about 35% from the high. So, if you care to define it, it gets defined as a bear market because it went down that far. And then it's been slowly inching up, and as of last Thursday, it was down just about 9.3% from the beginning of the year. But and I actually didn't look to see what the market did today, but on Friday it went down, and it may be a little bit lower than that at this point. So, I think many people might have looked at their March 31st statements and thought, oh my God, I've lost money. Well, unfortunately, losing money can be a part of investing. It's almost always a part of investing. And we need to put this into perspective. So let's look over the past 2 years. So this started from a 2-year time frame ending on the 30th of April. And you can see there are 2 points, one late in 2018 where the market went down, and the other one that we just had, and now it looks kind of compressed. And the market is actually looking like it's up 14.47% over that 2-year time span. And sure, it's it's a roller coaster ride, but maybe that's not so terrible. We have kind of lost a lot of the gains that we got in a stellar 2019. But when you put things into perspective, it's maybe not the end of the world. So let's talk about the quarterly results, and let's be a little bit more specific about what's been happening. And these are the results as of March 31st. So it is as of the first quarter. And remember, the market has come back a bit since then, so these numbers look particularly bad. But they probably match things that are on your statements. So we already talked about the S&P 500 total return, and the first quarter it was down 19.6%. But when we look at 3 years and 5 years, we have 5.1% and we have 6.73% for 5 years annualized. So that means on average, even though that never happened in any particular year, but on average over the 5 years, you got a gain of 6.73%. And these, we like to think that the S&P 500 over the really long run does a bit better than this, but the reality is on any given time period over any given 5 years, you might have periods of muted return. The Dow Jones Industrial Average, which tend to be the very large stocks, and maybe stocks that are, less tech heavy, that went down a little bit more in the first quarter. But over the 5 years, it's ever so slightly higher. NASDAQ Composite So this is an index that's very heavily technology. Names like Facebook and Google, which is now Alphabet, Apple, these might heavily influence the NASDAQ Composite Index. And the first quarter of 2020, it really didn't go down quite as badly. And you're still up very nicely over the 3 and 5 year period. International developed markets, now those have been pretty bad. Of course, not all those companies have done that badly over the 5 years. But in general, the U.S. economy has done better than the rest of the world. And hopefully I saw a flash on my screen. Hopefully everybody's still connected. Yep. Okay. The international markets have been down heavily, both the developed markets, the global markets overall, and the emerging markets. It is quite likely that some of these emerging markets, other than China, which is still considered an emerging market, might do quite badly after the coronavirus. But in a lot of cases, when you look at these indexes, because they haven't done much over these 5 years, they're actually starting to look pretty darn cheap. So there could be some advantages in diversifying. Let's talk about bonds a little bit. The U.S. bond market, which the Barclays Aggregate Bond Index is a broad bond market index that is generally used to track the bond market. That was up in the first quarter, 3.15%. Other than gold, that is the best performing asset here. And over the 3 years and over the 5 years, that has performed best. We'll talk a little bit about that later in this webinar, but a lot of that has to do with the fact that interest rates were lowered over this time period. And now interest rates are really low. Short-term rates are around zero. So are we going to get these returns in the future from the bond market? It's unlikely. Gold has really done quite well. So these are the gold spot prices, and 6.22% since the beginning of the year. And over the past 3 years, almost 9%. And 5 years annualized around 6%. So gold has kind of held its value and gained quite well. And real estate, so what I have here is the Dow Jones U.S. REIT Index. REIT stands for Real Estate Investment Trust. You can think of this as a good indication of real estate in the U.S. market. And that's been worst of all, down 25% for the first quarter. And that first quarter number has really sort of dragged it down for the 3 years and for the 5 years. And the question is, why is real estate down so much? Well, there's the real estate has a number of different sectors. So some of those sectors are down a lot more than others. For instance, residential real estate is actually not down very much. Multifamily is holding up quite nicely. But think about all those malls and what's been happening with retail and what might happen in the future. And, retail has just been devastated. And it's not clear that that's coming back. And the other reason for that 25% decline is things like travel real estate. So hotels. Yes, we're going to have hotels in the future, but a lot of hotels are making no money now, and travel is not going to be high on anybody's priority list. Companies are not going to be sending people to conferences, so the travel industry is poor and likely to continue to be poor for at least the near term. Restaurants as well. So all of that goes into the real estate index. So let's talk a little bit about the COVID-19 crisis. Much of the U.S. is under lockdown. This started on the 7th of March or so in a lot of places, and it's still going on in places like New York and New Jersey and California. There are places that are beginning to open up. New cases have leveled off in some areas, but the U.S. still had almost 28,000 new cases. Those are new diagnoses as of April 30th. We really haven't had the testing we need. So the criteria for opening up the economy, they're really saying that we need far more testing than we currently have. Also, that testing needs to be easier because taking a coronavirus test is very difficult at this point and unpleasant. So people are not going to want to be tested that often. They are working on new ways of testing from saliva, from just spitting in a cup, or from blood, and those are far easier than the current test. So we are making progress. There were 100,000 new tests a day at the end of March. Now we're at 200,000 new tests a day at the end of April. The World Health Organization has said that we will have enough testing if those tests are only 10% positive. It's a bit more than 10% positive at this point nationwide, but places like New Jersey are actually about 40% positive. States are under pressure to open business. So we have tremendous unemployment, people who are not getting paychecks. A lot of that is going to come out of state budgets. Some of it's going to be federal. If people are not working, they're not paying taxes. So the CARES Act also delayed the deadline, so the tax revenue is not coming in right now, and that's causing budget problems for the states. And then we're starting to see some civil unrest. We have protesters who want things to be open, and people are under stress in their pocketbooks, and they may see their businesses failing because of lack of customers, and they want to change things. So it's not surprising that we're seeing a bit of civil unrest, and hopefully that's not going to get worse, but it's going to put these states, even states where the governors say they're not listening to the protesters, it's going to put them under pressure. So I've actually been tracking COVID-19 cases in New Jersey and Bergen County since I decided to lock down, or had to lock down here in my home. And I think it's kind of interesting. You can see where we are by these tracking. So for New Jersey, you can see on the dotted line, the dotted blue line, that things were rising quite a bit, and then they were steady for a while, and now they do seem to be dropping. So that's probably maybe the last 10 days or so, there's been a drop. It's not even quite 2 weeks. I look forward to further drops, and I hope that's going to happen. You can see that Bergen County has been dropping for a much longer time. So that's the orange lines. That's the county that I'm in. And that's been dropping. It's been a slow drop, but it has been dropping. And so the fact that New Jersey was steady for a while, that kind of indicates that other counties were going up while Bergen County was going down. Bergen County was the most badly hit up until this point. We started a little bit earlier, probably because of all the commuters to the city, and the virus was brought into the county. So, places in southern New Jersey have less of a connect to New York City, and that's probably why they were delayed. But they were still going up. I think they're probably steadied out now, and we need those to drop as well. Positivity, which is the percentage of the test cases that are positive, that's got to drop as well. It drops for two reasons. One is fewer people get sick, and the other reason why it might drop is if more people who are not sick get tested. So it's both an indication of the fact that our testing, at least in this area, is still not quite adequate, as well as the fact that that people are still getting sick. So the positivity is getting better. It's around 40% now. I think I read that, so this was as of late last week, but I read that over the weekend it's still right around 40% for New Jersey. Other parts of the country are actually much better. So we're seeing encouraging signs, but we might not quite be there yet. So when will we have a reopening? This was a graphic from the New York Times. So it shows the states that are doing partial reopenings. Georgia's been in the news for that, but actually there are quite a lot of other states that are doing it as well. They're not just saying, even Georgia is not just saying, oh, business as usual, you can open the doors, go out to the bars, go and party. Maybe some politicians are saying that, but others are not. So what they're doing, though, is they're opening up to a new normal that's a bit different. So the yellow states, and unfortunately we're in a yellow state, we're not quite ready to reopen yet. And the New York, New Jersey metro area, I think Connecticut, New York, and New Jersey, maybe Pennsylvania as well, they've decided that they're going to coordinate their reopening of the economy, and in order to make sure that you're not reopening one and not the other and causing problems. So what's reopening going to look like? So this is what I expect. I expect that stores will be able to reopen. The consumers and the staff will have to wear masks, and that's going to be true for a while. Restaurants will be able to reopen, but they're going to need to provide more distance between tables. We are getting into the summer season. Those restaurants that are able to see people outdoors, wow, that is just perfect for this situation. And those restaurants hopefully are going to start doing more business. We're going to start having some sports. I believe NASCAR said that they were going to start. I did see something about Major League Baseball, but I'm not sure when that's going to be. I think NASCAR, it's going to be in 2 weeks, I think I read. So most of that's going to be for the TV cameras. I think that it's going to be a while, maybe not this summer. It's going to be quite a while before they allow fans in to see the sporting events. We're not quite ready for that. I think factories and offices are going to reopen. I think that businesses are going to be encouraged to provide stay-at-home options for their employees if possible. I think a lot of businesses are going to want to try to get testing for their employees. Hopefully there will be some options for that in the private sector that will allow that, because the factories and offices want to reopen, but they also want their employees to be safe. The worst thing in the world will be to have employees come back to work and somebody gets sick with COVID-19, gives it to a lot of other employees, and it's possible there'll be some lawsuits. The government is talking about trying to limit those lawsuits. We'll see if that's successful. And then we have schools and colleges. I would expect that they are going to wait until September before having in-person classes, but there is tremendous pressure. I mean, tremendous pressure for those classes to be in person in September. So I would expect, unless things are in horrible shape, that they will find some way of doing that. But there is going to be behavior changes. I think people are going to eat out less. We're going to have empty bars because a lot of folks are not going to be comfortable going out and being in close quarters with other people. I think we're going to have few events unless they're outside. Certainly business and corporate events are not likely to take place. Organizations that I've been part of, most of them have canceled their schedules for most of the rest of the year. That includes charitable organizations. So I think there are not going to be a lot of events unless they are able to be held outdoors. I think that while people may start to travel, I think that people are not going to want to travel unless it's necessary. If you have a house rental at the beach, you might feel comfortable doing that over the summer. Sure, why not? I think that might be fine. But if you had an airplane ride where you were going to visit Disney World, I think it's not that likely you're going to move forward with that. So you're going to have other behavioral changes. People are going to be reluctant to send their kids to summer camp. I think that you'll find a lack of foreign college students on campus this fall. That might be hurting some of the colleges and universities. Many students might prefer to commute to college. And the upshot of all this is that unemployment might end up being stubbornly high. So getting into the economic situation right now, we have GDP. That's a good indication of gross domestic product of economic conditions. This is a graph that the Federal Reserve Bank of St. Louis puts out, and it shows that in the fourth quarter, we had I'm actually not sure what that is, but probably around 2% of growth. The first quarter came out and it's negative, but we only had part of the coronavirus situation in that, and that was down, just 1%. The forecast for this right now, so for the second quarter, is that GDP is going to be down 16% or so. This is a forecast, and this is annualized data. So it may actually look worse than what it really is, but it's certainly going to be negative, and there's no question that we're in a recession. We will be in a recession. It's not marked on this graph because the Fed decides on recessions retroactively. So sometime later this year, they're going to decide that we actually were in a recession. And you can see the unemployment graph. So for most of last year, the number of continued unemployment claims was under 2 million. And now it's just gone through the roof. So I'm not sure what percentage unemployment is going to be. Right at this point, in May, beginning of May, it could be around 30%. Now, some of that is artificial because people are furloughed and they are going to get back to work. So the real question is, what is this going to look like after reopening the economy? We've had a lot of government fiscal stimulus. So we've had the $2.2 trillion CARES Act. Just quickly reiterating that, it provided stimulus payments to most Americans. Many of you may have gotten that already. If you haven't, you should go to irs.gov because there are ways you can register your banking information if the IRS doesn't know about it, and you should do that. You can also register with them if you were not a taxpayer. There are enhanced unemployment benefits. There are loans and grants to small business. Some of this is controversial, but on the whole, it is helping people staying employed and on the payroll, so it's a good thing. There's higher education emergency relief. There's actually $500 billion in that bill to aid large corporations, $100 billion for public health, including hospitals, and there was $340 billion for states just to deal with the COVID-19 response. We've also had since then, because the small business funding ran out, we had an additional $370 billion for small business. In addition to that, we've had monetary stimulus from the Federal Reserve Bank. So short-term interest rates have dropped to near 0%. The Federal Reserve is buying bonds. That's called quantitative easing, something the Fed came up with during the Great Recession, 2008. They're going to buy assets including treasury bonds, mortgage-backed securities, and even commercial loans. The Fed is going to offer unlimited loans to banks and security firms. The Fed wants to keep banks afloat, no matter what happens. The Fed is also backstopping money market mutual funds. We have had liquidity problems in money markets. The Fed is making sure that that's not going to happen. They're going to provide that liquidity when it doesn't exist in the market. The Fed supporting repurchase agreements. The Fed is also directly going to lend to large corporations if they can't borrow on the open markets. The Fed is going to support consumer loans through something called TALF. The Fed will lend directly to state and municipal governments. So there's a tremendous amount of monetary stimulus. Some of this is actually borderline and fiscal stimulus as well. So let's get into what might be happening with your retirement accounts. Of course, I can't tell you what's happening directly with your retirement accounts. So what I decided to do is I created a naive 60-40 portfolio, just using some broad Vanguard exchange-traded funds, because I wanted to show what this might look like between January 1st and March 31st. So remember, the S&P 500, that was down like 19%. But you're not just invested in that. You're invested in bonds. You're invested internationally. You're invested in a lot of areas. So this 60-40 portfolio is 60% stocks, 40% bonds. 5% of the bonds are international. 10% of the stocks are international. This probably does not match your portfolio. So it is just one example of a portfolio outcome. And it was down 12%. 12% is painful. There's no question about it. And it was probably down around 18% at the worst moment in time there in March. So it's painful, but as long as your time frame is not today, or maybe this year, you have some time, and investments do have a tendency over the long run to rise. So you have to keep that in mind. Let's quickly talk about recovery scenarios. So if you've been paying attention to financial news, they talk about the V shape, the U shape. I'm not even sure what the other shapes might be. I think we're beyond the V shape. That's not what's going to happen here. The top blue line. Maybe we're going to have something between the orange line and the gray line. They're saying that means that the total contraction for 2020, according to the Conference Board, which is a well thought of think tank, that's going to be down, somewhere between 5 and 6% for the year. That is certainly possible. Important thing to realize here is that all of these are really showing the lows sometime between May and the summertime. I think we're probably a little bit closer to the V shape. It's likely because today everything is shut down. I would expect in a month less will be shut down, which means we will have more economic activity. So talking a little bit about stimulus and recovery, there's some questions there. Will we need more stimulus? How long will unemployment linger? Is there even the political will for more stimulus? They are talking about it, but they're also fighting about it. And what ultimately will that stimulus do to our economy in the long run? These are all questions that we can spend a long time discussing, maybe in the Q&A, but there's certainly things to think about. Another thing we should quickly talk about, and I am definitely running over time here, so I'm going to try to rush through this a little bit, is inflation. The monetary and fiscal stimulus can cause inflation. They can be inflationary. Printing money, which is basically what they're doing, causes inflation, but typically not when there's so much slack in the economy. So yes, it may cause inflation, but that inflation is probably going to be down the road if it exists. You have to think about what form the inflation is going to take. So one possibility is that the dollar may drop in value. This is a form of inflation because we import so much, so that means imports will possibly increase in price. Countries like China may have less room to actually manipulate their economy. So it remains to be seen if that's going to happen, but it's possible. We may have commodity inflation. So if there are shortages in key areas, so I don't think that's going to be in oil, that's clear. We've got plenty of oil, no problem there. But we could have shortages in meat. We may have long-term shortages in drugs because of our supply lines. Our supply lines for drugs are fairly fragile, shall we say. Things like cleaning supplies. So there are certainly things that we should keep an eye on as far as inflation is concerned. But still, the stimulus and the Federal Reserve Bank probably has a long runway for now. Certainly for a while this year, we're unlikely to get inflation in the short run. And the bigger risk is probably deflation from lack of demand. So again, the question is, where are the markets going to go from here? Did we see the lows in March? Well, the stock market looks forward. So the real question to ask is it going to get better from here or worse from here? And is that priced into the market? So it wouldn't surprise me if the market goes down, but it would surprise me actually if the market went down more or a lot more than it was down in March, because things are going to start looking a little bit better. They may not look like 2019, but they're going to start looking a bit better. But the stock market is volatile. It panics easily. So again, I would expect some volatility. The market's had a nice run in April, and it's certainly possible in the short run that it could go down. Not that I would take action on that necessarily, because again, this is a crystal ball and we're not necessarily correct. So the question is, will the economy be better on December 31st than it is now? And that's the question you should be asking when you think about the stock market. The bond market is a slightly different story. So low rates mean low returns. So U.S. Treasury bonds are extremely safe. If you buy a bond and hold it, you're going to get the yield on the bond. But the 10-year note yield is right now about 0.6% for 10 years. So there are ways of getting higher return, which means other bonds, corporate bonds, municipal bonds, international bond markets, but they all involve taking on more risk. And some of that risk may be worthwhile, but some of it may not, and you do have to be careful. Higher returns will always mean more risk. Okay, so Mike's going to take it from here. Mike, do you want to do one of those poll questions, or are we going to skip those because we're kind of running out of time?
Um, well, we have a couple of poll questions. Why don't you try the next one, David, real quick, and then we'll keep moving along.
Okay. So let's do this one here about income. Has your income gone down due to the COVID-19 crisis? Yes, no, or not sure yet. Right now, it's running kind of neck and neck. Has your income gone down due to the COVID-19 crisis? Again, the answer is yes, no, or not sure yet. Okay. So this is our current results, and 23% said yes, so they know that their income has gone down. 47% is no. So since they're not sure yet, they are not sure yet. I would say that they're pretty confident that their income is going to stay the same or possibly rise. And 29% aren't quite sure yet, which is perfectly valid. You don't know if your business is coming back. And there's a lot of unknowns here. So interesting results. All right, Mike.
Okay. So yes, interesting results, and partly drives why we're holding this webinar today. And in fact, the coronavirus has dealt us some financial and economic lemons that we hope we can point out a few ways to try to turn those lemons into lemonade. But unfortunately, just as there's no miracle cure, or at least there's no cure yet for COVID-19, we don't offer miracle financial cures. We can't necessarily control the outcome of what's going to happen. But what we're suggesting are some things that we can do to perhaps take action to improve our chances of future success in our retirement planning. In talking about that, we'll consider three aspects. Really managing expectations and what have we learned about our lifestyle preferences, as well as talking about some possible changes to savings and investments, and then we'll cover some planning opportunities near the end. So, next slide. So how do we be prepared for something like this next time? Of course, no one could have predicted a pandemic. No one could have predicted a total or near total shutdown of the economy. Points up the need for, what if it happens again? Well, if we're not okay, what do we need to do to make ourselves okay to get through it next time? And while many of us, if not most or all of us, are spending more time at home, just a perhaps interesting lifestyle observation. Is this kind of like has it been kind of a trial run for what your retirement might look like on a day-to-day basis? And if so, it may give you the opportunity to think about how would you want to spend your time in retirement when that time comes. Certainly, I think for many, people will feel they need to build or rebuild their retirement nest egg, and it involves, unfortunately, perhaps an adjustment of our future expectations. Maybe, based on your situation, we might need to continue working longer than we originally planned before retiring. Depending on how we've managed through this crisis so far, we've had to reduce spending, or we should be considering reducing spending going forward. And also perhaps paying down some debt so that we can build up savings and be prepared not only for the next crisis, whatever it might be, and the next crisis is never the same as the last crisis, but nevertheless, it helps to build in a cushion to try to be prepared. Next slide. So we think of retirement income as being a three-legged stool, three components being Social Security, guaranteed income, and investments. Most of the time I'm going to spend today will be talking about the savings and investments component, the leg on the right there, but we'll touch briefly on Social Security and guaranteed income next. So you're working, or you have worked and paid into the Social Security system generally over your working life in order to have a benefit be paid back to you when you retire. So Social Security is an inflation-protected guaranteed income stream. It's also, I would say, a form of longevity insurance provided by the government. But it's very important to think about when to begin claiming Social Security. People in perhaps tighter financial straits might think that taking Social Security as soon as they can when they reach age 62 is the way to go. Generally, as financial advisors, we advise against that because you permanently or nearly permanently lock in receiving benefits that would only be 75% of what you would receive if you waited until your full retirement age. If at all possible, if you can defer beginning to receive Social Security to age 70, those few years you wait after your expected full retirement age, as Social Security defines it, generally that's between ages 66 and 67 these days, the amount that you'll receive goes up by about 8% a year. So the maximum, up to a maximum level at age 70. And Social Security won't make you rich, but it does provide kind of a baseline of guaranteed income, which also is adjusted for inflation. Next slide. So in thinking about the guaranteed income leg, this is an additional source of stable income for your spending needs in retirement. Generally speaking, the sources that we think of as guaranteed income would be, and this is unfortunately not as prevalent as it used to be, but a defined benefit pension plan. If you're fortunate enough to have one of these, it's a very good thing. Most young people, unfortunately, probably won't have the benefit of it as they move closer to retirement. But a defined benefit pension plan is one that is set up to provide a guaranteed stream of income to you in retirement. I won't spend too much time on reverse mortgages, but reverse mortgages, despite their perhaps less than stellar reputation, do have a place possibly in our financial plans. There are a few things that you need to be sure of if you want to consider a reverse mortgage. I think the first one would be that if you are considering it, that you choose the government guaranteed reverse mortgage option. The Federal Housing Agency provides a product that guarantees benefits under it. You also, perhaps most importantly, need to be nearly absolutely sure that you want to stay in your house for the rest of your life as your health declines and as you age. Because reverse mortgages don't require that you make cash payments to pay them back. Reverse mortgages get paid back when you leave the house. And that generally means when you die. And if you intended to leave your house to heirs, don't take a reverse mortgage, because the way the lenders get paid back is sale of the house to recoup the amount they've lent you during your retirement years. And finally, there are some considerations with respect to annuities, which also can be beneficial, and we'll cover those in the next slide. So annuities come in many stars and stripes and flavors. They're written in language that's too difficult for anyone to understand except the people who sell the products, generally speaking. And it's important that there can be lots of reasons provided for why someone should buy an annuity. The important thing to remember is that the need for guaranteed income would be the only reason you'd need to consider buying an annuity. There have been some helpful developments in the products lately, where there are lower cost options and non-commission annuities. But generally speaking, you can get guaranteed income, but it's going to be based on the prevailing level of interest rates. So as David pointed out, with interest rates being really low now, a straight fixed annuity is not going to be terribly attractive in the current environment. There are other annuities that may provide returns that might be linked to perhaps stock market returns, with some protections if the market declines. Those are more complex products, but they are worth a look, and they can be beneficial perhaps in this environment. Just as with Social Security, annuities are designed to be longevity insurance for you. So you buy an annuity, if you outlive your life expectancy, the insurance company has contractually agreed to pay you a benefit for as long as you live. So if they wind up paying out more than you've paid into the annuity, effectively, as long as it's a healthy insurance company, it's kind of their problem, but one that they sign up to take the risk of doing, because not everyone outlives their life expectancy. So in underwriting a pool of these contracts, some people will live longer, some people unfortunately won't live as long, and the way they manage their reserves to pay out on these contracts is to count on that pooling benefit. So now we'll move on to the savings and investment leg of the stool. And one of the things that I think the market decline pointed out, the sharp decline, is something that we call sequencing of return risk. So imagine yourself getting ready to retire in February, and all of a sudden the market's down 33%, and you were counting on your stock investments to be a substantial portion of what you draw down during your retirement. So now your retirement is not looking nearly as comfortable or confident. One of the things that we financial planners try to build into everyone's plan is the concept of an emergency fund. And before the COVID crisis, I guess we'd say, be prepared to have enough cash set aside to cover your living expenses for anywhere from, say, 3 to 6 months. With kind of an unprecedented shutdown that we've experienced, I think we're tending to feel that the amount that you need to set aside should be larger to cover a longer period of time. And particularly when you're approaching retirement, if you have a cash bucket that may cover your first couple of years of retirement spending, then it may cause less anxiety about a market decline and enable you to have a strong enough stomach to hold on to those investments while they go down and give them time to recover. Having witnessed the market decline and the partial rebound since that point in March when it reached its lows, our general advice would be, when you look at your accounts, don't jump. And that means physically as well as perhaps figuratively, don't jump to conclusions. Hopefully you haven't reached your GMO point, the point at which you can't stomach the volatility any longer, and you call your financial advisor and say, GMO, or get me out. So hopefully we'll work with you, or your financial advisor will work with you to help you avoid reaching that pain threshold. So the market's bounced back pretty well, not completely, as David pointed out. What does that mean in terms of your ability to, or your tolerance for risk? Doesn't seem so bad now, perhaps. What if it went down again in a similar way? How strong is your stomach to take that? And maybe that means that it's time to reconsider your asset mix, perhaps not as much invested in stocks, or if you're aggressive and you've got a long time before retirement, perhaps adding to your stocks. In any case, volatility offers us a good chance to rebalance our investments. which essentially means buying more of what went down and perhaps taking a little off the top of assets that have gone up. There are a couple of platforms that David and I work with for our clients who have automatic reinvestment, rebalancing, I should say, built into their trading tactics, and we find those very beneficial. If you've only owned U.S. financial instruments up till now, maybe it's the time, as David pointed out, to consider diversifying into foreign markets as well. Although all seem to be correlated in the short term, generally speaking, there are different economic drivers in a more diversified international portfolio of securities, and some of that can be beneficial to growth going forward. The U.S. won't continue to outperform forever. And in your asset mix, if you've only held stocks and bonds up to this point, with the, I believe, possibility, perhaps more than just a possibility, of inflation arising in the future, and perhaps with a decline in the value of the dollar, as David pointed out as well. What are some things that can help hold your portfolio value in a situation like that? And that's where we think about things like real estate, particularly residential real estate, and not necessarily just meaning your house or your condo, but perhaps some publicly traded real estate as well. Gold, as David pointed out, seems to have held its value and gained nicely. Perhaps gold or other commodities might also be helpful in an environment of inflation. Next slide. So, recognizing and trying to be mindful of your time. Apologies that it's now 1 minute after 1 and we're just now getting to planning opportunities. I'll try to go through these quickly, so if you can stay with us, we'll try to cover them fairly quickly. Here's the list, and I'll just skip to the next slide to talk about the first one. So with the CARES Act, as David pointed out, the government has extended your income tax filing deadline for 2020 from April 15th to July 15th. That also means that you get until July 15th to contribute to an IRA for the tax year 2019, if you haven't already, or contribute to your healthcare spending account, which is a spending account you're allowed to set up if you're in a particularly defined high deductible healthcare plan. So you still have time to make those contributions and get a tax deduction for your 2019 return. And particularly if you're self-employed and you're setting up a self-employed IRA, a SEP IRA, and you happen to file a tax extension, so you don't actually file your taxes at July 15th, but you extend to October 15th, you can contribute to a SEP IRA up until the time that you file your extension on October 15th. Next slide. Next planning opportunity would be tax loss harvesting. So with the market having gone down, chances are in your investment accounts, taxable investment accounts, you've got some unrealized losses, meaning the value today compared to what you paid for it. A simple tool, although it might go against the grain of what you're used to doing, is to simply sell those investments. Realize capital losses for tax purposes. They can be used to offset any capital gains you might realize in 2020. And if you might say, well, the market's down, so I don't have any capital gains in 2020. It is only May, so there is a chance that the market will come back. If it doesn't come back, though, you can still deduct up to $3,000 of capital losses against your ordinary income on your tax return for 2020. And if you have more capital losses than that, you can carry those forward to future years to offset against future capital gains or future ordinary income. One thing to be careful of is the wash sale rule when you're reinvesting. So in telling you, or in suggesting perhaps that you consider tax loss selling, it's not simply to hold the proceeds in cash, but we'd encourage clients to stick with their plans and reinvest in similar assets. You've got to be careful when you're buying back the investment, for example. If you're buying back the exact same security, you've got to wait 30 days before doing that in order not to disallow the loss for tax purposes. One example might be, though, is that you could take the S&P 500 index fund, the most popular one, the ETF, which goes by the ticker SPY. That can be sold and immediately reinvested in the Vanguard ETF, S&P 500, which goes by the ticker VOO. So you're getting the same underlying exposure, but it's a different security. So it would be one that would qualify for or would help you avoid the wash sale rule. Next slide, please. So if you're taking RMDs, required minimum distributions from IRA accounts, generally that means you're already retired and have reached a certain age, but not necessarily. If you're perhaps taking required minimum distributions from an inherited IRA. The CARES Act allows you to effectively not take the distribution for 2020, which is helpful. If you happen to not need the money, then you don't have to pay taxes on it by taking the money. However, one planning opportunity or one planning consideration might be that if you're in a fairly low tax bracket, recognize that today's federal tax rates are historically low. And with the amount of stimulus that has been issued by the government, which has been increasing the federal budget deficit, makes it more likely that tax rates are going to be higher in the future. So it might also cause you to reconsider and say, well, perhaps it does make sense to take the required minimum distribution this year, pay tax at today's lower tax rates, and use that as a more immediate benefit. Next slide. A somewhat similar planning opportunity is to consider converting your traditional IRA or retirement accounts into Roth IRAs. Two questions to answer in each of our personal situations is, will my income be lower this year? And have my retirement accounts decreased materially in value? Not both. One of these only needs to be true, not necessarily both. But if both are true, then it becomes a more compelling thing to consider. You can convert your traditional retirement account into a Roth IRA. Pay less tax now than you otherwise might have had to pay, because if your income is lower, you're this year in a lower income tax bracket. Your retirement account value has gone down, so you're paying tax on the lower value that's being converted. Although it's still a tax hit to take this year, it enables your future growth in your Roth IRA accounts, income and capital gains, to be tax-free. Next slide. Depending on your situation, if you don't have cash to contribute to your healthcare spending account during 2020. This is a once-in-a-lifetime opportunity, but given the situation, perhaps people's situations might be more difficult than otherwise. Instead of trying to come up with cash to contribute, you can actually directly transfer money from your IRA to your healthcare spending account. So as mentioned, this can only be done once in your life, so consider carefully before deciding whether to do this. Although you won't get a deduction on your tax return for the direct transfer from your IRA, you also avoid early withdrawal penalties by taking that distribution from the IRA, and you don't pay income tax on the amount that you transfer from your IRA into the healthcare spending account. Of course, the amounts that can be transferred into your HSA are limited by the HSA contribution limits, which you can see there on the last bullet point. Next slide, please. All right, last planning opportunity is to suggest gifting. And although this slide says appreciated assets, I would think of it more as appreciable assets. So let's say you own security for which you paid $10 for it. Earlier this year, before the market took in, perhaps it went up to $20. Now it's back down to about $12. it's something that is volatile, perhaps can appreciate in the future, you can gift this to someone as long as the total value is within $15,000 per recipient. Or if you're filing a joint return, the value can be twice that, 30,000. It doesn't give you any immediate income tax savings, but it's a way to get appreciable assets into the hands of perhaps some of your intended heirs or beneficiaries earlier. So they'll get the future appreciation value, and especially if they're in a lower tax bracket and they need to sell the security and realize the gain themselves, they'll realize that gain at a lower income tax rate than perhaps you might be in. So those are our planning opportunities. Sorry for running over, but we now have time for questions and answers if you have them. And of course, if not today, then we're always available subsequent to this.
Yep. Mike, I have the slide up of how we can help you. Let's just say if you have questions for us, if you think you might be interested in our services, we'd be happy to talk to you. And with that, I'd be happy to take any questions. I don't see anything there right now, but just type your questions into the Q&A box. And sorry this went a little bit over time, but there's a lot of information there. So I'm not seeing any questions at the, oh, well, okay, we do have a question. Let me read it. I have money in an employer pension plan since 2012 when I left. Does it go down in value over time? So I think that answer is complicated because there's several different types of employer pension plans. So there is a plan that is an employer pension plan that's called a cash balance plan. I believe that cash balance plans, that what they're basically looking at is the investment value of a pool of money, and that's invested. If investments go down, that pool of money could go down. But there are many other types of pension plans that the guarantee is the benefit. So they're called defined benefit plans. And even though the underlying investments might have gone down, the plan sponsor is still supposed to pay you the amount that is specified in the plan, usually a formula that's based on your longevity with the employer and your age. So the answer is complicated. It depends on the pension plan. Most large employer pension plans, I'd say the answer is no. The value does not go down over time.
And I think the qualifier to that would be to be sure that you're vested in that plan in order to get that guaranteed benefit.
Right. Yep. And you can always call the your employer's pension department and ask them for a statement. Okay, next question is, can you create and contribute to a SEP IRA if you have already filed your 2019 taxes? I believe the answer is no, but it is possible you might be able to do an amended return. So I think we'd have to find out the rules on that. If perhaps with an amended return, then you can still make that contribution. But in general, the deadline is the day that you file your tax returns.
Yeah, I'm inclined to I'm inclined to say the same. You need to go through the same amended return process, but we can check um, with our accounting experts and let you know that.
Yep. Okay. Do I have to file either 2018 or 29 taxes to get the $1,200 stimulus check? This is referring to the stimulus payments that are part of the CARES Act, and the answer is no. So if you did not file 2018 or 2019 taxes, go to the IRS website, irs.gov, and there's a listing there where you can register as a non-filer. You should click on that, register your information there as a non-filer, and then you will be sure to get a payment for your stimulus. So no, you do not have to be a taxpayer in order to get a stimulus payment.
Maybe I would add to that make sure that you didn't have to file for 2018 and 2019. If it turns out that you earned enough income where you perhaps should have filed, you should go ahead and file those returns anyway.
Right, and those stimulus payments are regardless of your income, as long as your income is lower than the cutoff. So no income is too low. You should still be eligible to get a stimulus payment. Okay, any other questions from anybody? All right, thank you very much, everybody. And if you have any follow-up questions, please feel free to contact us. We'll do our best to just help you. That's really what we're in it for anyway. And I will be sending out probably tomorrow a follow-up email, a link to the recording of this webinar, and then maybe some additional information. And thank you very much. I hope everybody stays safe. I hope everybody stays healthy. I hope your loved ones are healthy and safe. And thank you very much.
Thank you very much, everyone. Appreciate it.